Welcome back, looters. I'm about to pull back the curtain on the single mistake that cost me more than a few $100s. It wiped out almost half of my trading account in a single afternoon. Picture this. I was fresh off a weekend of watching quick cash videos, convinced I had the perfect entry on pound sterling to Japanese yen at 150.30. I hit the buy button, felt that rush of excitement, and then nothing. The price never moved in my favor, and before I could even blink, my balance was flashing red. The truth? I had completely ignored the one safety net every serious trader swears by: risk management. I didn't set a stop loss. I didn't calculate how much of my bankroll I was risking, and I let my ego drive the trade. In the next two scenes, I'll break down exactly how I ignored that safety net, how leverage lured me in like a siren, and what you can do right now to protect yourself from the same fate. Trust me, this isn't a hype reel. It's a raw confession from someone who learned the hard way that a single careless trade can turn a promising start into a costly lesson. Stick around, because the next part will give you a concrete, actionable rule you can apply before you even open your next chart. All right, let's dive into the second mistake that burned a chunk of my account: ignoring risk management. I was staring at the euro to US dollar chart, saw a tempting pullback at 1.1050, and thought, I'll ride this wave and make a quick profit. I entered a long position, but I didn't set a stop loss because I was convinced the price would bounce back. Within minutes, the market reversed, dropping straight through my entry and plummeting to 1.0980. That's a 300 pip loss, which, on a $10,000 account, translates to roughly a 15% hit, far beyond any sensible risk rule. The hard truth is that every trade should have a predefined exit point, and you should never risk more than 1% of your capital on a single idea. Here's the actionable step you can take right now. Before you click that buy button, calculate your position size so that a stop loss of, say, 30 pips only costs you $100 if you have a $10,000 account. Write that stop loss level on a sticky note or set it directly in your platform. By making this a habit, you protect yourself from catastrophic losses and keep your trading journey sustainable. Remember, the market will always move against you sometimes. A stop loss is your safety net, not a sign of weakness. Now for the third confession, the leverage temptation that literally blew my account to pieces. I was looking at US dollar to Japanese yen, which was sitting nicely at 110.00, and I thought, with 1:500 leverage, a tiny move could turn this into a huge win. I opened a long position, put only a few $100s on the line, and cranked the leverage up to the maximum my broker offered. Within a single 15-minute candle, the price slipped just 10 pips to 110.10. That sounds tiny, right? Not with 1:500 leverage. That 10-pip move multiplied my exposure by 500, wiping out my entire $5,000 margin in seconds. The lesson here is crystal clear. Leverage is a double-edged sword. It can amplify gains, but also magnifies losses, often beyond what you can afford. The actionable rule you can apply today is simple. Keep your leverage at 120 or lower until you have a proven track record, and always calculate your position size based on the actual dollar risk, not the leverage amount. Use a position size calculator. Set your maximum loss per trade to 1% of your account and stick to it. By treating leverage as a tool, not a shortcut, you protect yourself from the kind of account-crushing surprise that I experienced. Remember, the market doesn't care how much leverage you use. It only cares about price movement. All right, looters, let me tell you about the time I chased a hot trend and completely wiped out the gains I'd built. I was watching the euro to US dollar sprint from January 2000 up to 1.2150 in just a couple of days, and the market looked like a roller coaster I had to ride. I didn't have a written plan, no entry criteria, no stop-loss rule, just pure excitement. I jumped in at 1.2130 because the price was still climbing, thinking, if I wait any longer, I'll miss the move. In reality, I entered on impulse, left my stop loss at the previous swing low, and that swing low was nowhere in sight. Within 4 hours, the pair reversed, fell back to 1.2005, and I lost roughly 150 pips, about $300 on a $1,000 account. The lesson? Never let a trend dictate your actions without a clear plan. Before you enter, write down exactly what price level triggers your trade, where your stop loss sits, and how much of your account you're willing to risk. Usually no more than 1% per trade. Use a checklist. 1. Does the price respect my entry rule? 2. Is my stop loss defined? 3. Does the risk-to-reward ratio meet at least 1 to 2? If any answer is no, walk away. A plan turns a wild ride into a controlled journey, protecting your capital and giving you confidence to stay in the game longer. Here's the raw truth. I skipped the demo account entirely and dove straight into a live $500 account, convinced I was ready to make money from day one. I thought, I've watched enough videos, I know the basics. Why waste time on a fake platform? That mindset cost me $150 in the first week. I opened a pound sterling to Japanese yen trade at 151.20 because a tweet said it was a breakout, but I never tested the entry on a demo, never practiced my stop-loss placement, and I didn't rehearse my risk management. The price slipped to 150.90, and my stop never triggered because I hadn't set one. I panicked, manually closed the trade, and watched the loss lock in. The pain of losing real cash is far sharper than a virtual loss on a demo. The actionable fix? Treat the demo as a real classroom. Spend at least 2 weeks trading on a demo, aiming for a consistent win rate of around 55% and a risk-to-reward ratio of at least 1 to 2. Record every trade, review why you entered, and adjust your plan before you ever risk a cent. When you finally move to a live account, start with a small capital, no more than 5% of your total savings, and keep the same risk rules you practiced on the demo. That bridge from pretend to real can save you hundreds, if not thousands, of dollars, and keep your confidence intact. Picture this. I was on a losing streak, my account down 10%, and instead of stepping back, I kept opening new positions every hour, hoping the next trade would magically reverse my fortunes. I was chasing emotions, fear of missing out, anger at the loss, and a desperate need to prove myself. Within 48 hours, I had executed 12 trades, each one larger than the last, and my sleep schedule was a mess. By the end of the week, I was exhausted, my decision-making foggy, and the market kept beating me. The result? I burned through another 8% of my capital and felt mentally drained. Overtrading isn't just a bad habit. It's a recipe for burnout and long-term loss. Here's the fix you can apply right now. Set a hard limit on the number of trades per day. My personal rule is no more than 3 high-quality setups, no matter how tempting the market looks. Use a timer. After each trade, step away for at least 30 minutes, review the outcome, and ask yourself if you're trading based on a solid plan or just emotional impulse. Keep a trading journal that records not only entry and exit points, but also your emotional state. Rate your stress on a scale of 1 to 10. If you ever hit a 7 or higher, stop trading for the day. Finally, schedule regular breaks. A short walk, a stretch, or a non-screen activity every 2 hours. By treating trading like a marathon, not a sprint, you preserve your mental stamina, make clearer decisions, and protect your account from the inevitable fatigue that comes from overtrading. All right, let me tell you about the day I completely ignored the economic calendar and paid for it in real time. I was staring at the euro to US dollar chart, convinced the pair was about to break out to the upside because the price had just bounced off a green support line at 1.0800. I jumped in with a 150 leverage, thinking I'd ride that wave all the way to 1.0900. What I didn't see was the headline level data that was about to drop. The European Central Bank was set to announce a surprise rate cut that very afternoon, and the U.S. non-farm payrolls were scheduled for the same hour. Those two events together created a massive volatility spike that sent the euro tumbling and the dollar spiking. Within 10 minutes, my position was underwater, the red candles were flashing, and my stop loss was hit. I lost almost 30% of my account in a single trade. The lesson? Always, always, glance at a reliable economic calendar at least 15 minutes before you place any trade. Set alerts for high-impact events like interest rate decisions, employment reports, and central bank speeches. If an event is coming, either stay out or tighten your risk dramatically. Reduce position size, tighten stops, or shift to a lower leverage account. Treat the calendar like a traffic light. Green means go, yellow means caution, red means stop. By making that simple habit part of your pre-trade routine, you'll avoid the nasty surprise moves that wipe out beginners in minutes. When I first started trading, I thought I had found the holy grail of information, a single Twitter account that seemed to predict every market move. I followed that one feed, semi-alerts, and started making trades based solely on those tweets. At first, it felt magical. My wins piled up, and I started bragging about my secret source. But the reality hit me hard when the euro suddenly slumped after a surprise ECB announcement that none of my favorite tweeter had mentioned. I was left holding a losing position, watching the red candles devour my account. That's when I realized the danger of putting all my eggs in one basket. The Forex market is a massive, global arena, and no single source can capture every nuance. The fix? Diversify your information streams. Pick at least 3 reputable sources: a major financial news outlet like Bloomberg or Reuters for macro data, a central bank website for official statements, and a real-time market sentiment tool like a Twitter feed or a dedicated Forex forum. Set up a simple workflow. Start your day by scanning the economic calendar on investing.com. Then read the ECB or Fed press releases, and finally glance at social media sentiment for any emerging narratives. Use RSS feeds or a news aggregator to pull these sources into one dashboard, so you're not hopping between tabs. Cross-check any trade idea against at least 2 independent sources before you press the button. If the data aligns, you have a higher confidence level. If it conflicts, step back and reassess. By building a diversified information diet, you protect yourself from echo chambers, fake news, and the occasional rogue analyst. This habit turned my trading from guesswork into a disciplined, research-driven process. If you stuck around this far, you already know I'm not about hype or empty promises. I'm here to share the raw, unfiltered truths that saved my account and could save yours. That's why I'm asking you to hit that subscribe button right now. Why? Because every week I drop a new confession, a fresh mistake, and a practical fix that you can apply instantly. No fluff, just real-world tactics you won't find in glossy marketing webinars. By subscribing, you'll get early access to my Mistake to Profit series, where I break down a single error, like over-leveraging or ignoring the calendar, and give you a step-by-step action plan that you can test on a demo account before risking real money. Plus, I'll send you a free checklist every month that consolidates the most common pitfalls and the exact rules I use to avoid them. Think of it as a cheat sheet for your trading journal. And because I value community, subscribers get a private Discord where we dissect live charts, share news sources, and hold each other accountable. So go ahead, click that red subscribe button, ring the bell, and join the looters who are turning their mistakes into measurable profit. Remember, the market rewards consistency, not chaos, and together we'll build that consistency one honest lesson at a time. Watch the full lesson on Tick to Loot to master this completely.